Your employer's $400 monthly match disappeared the day you quit. And 23% of Americans who changed jobs in the past 5 years lost an average of $7,800 each because of something called a vesting schedule that nobody explained during orientation. That free money promise your HR rep made? It comes with a timer, a penalty structure, and a set of rules designed around the statistical likelihood that you'll leave before the company has to actually give you anything. The match exists, it goes into your account, you watch it grow for 2 years, and then when you take a new job, your employer claws back 60% of it. Legally. This isn't a scam. It's the design. Here's what actually happens when you sign up for that retirement plan. Your company says they'll match 50 cents on every dollar you contribute, up to 6% of your salary. If you make $60,000 a year and put in $3,600, they put in $1,800. That's the pitch. What they don't lead with is the vesting schedule, the timeline that determines how much of their contribution you actually get to keep. The most common version is a 6-year graded vesting schedule. After year 1, you keep 0% of their match. After year 2, 20%. Year 3, 40%. It scales up 20% per year until year 6, when you finally own 100%. The average American worker stays at a job for 4.1 years. At 4 years on a 6-year schedule, you keep 60% of the match and forfeit 40%. On that $1,800 annual match, you lose $720 per year you worked there. Over 4 years, that's $2,880 that went into your account and then vanished when you left. Some companies use cliff vesting instead. 0% for 2 or 3 years, then 100% all at once if you're still there on that anniversary date. Leave 11 months into year 3 on a 3-year cliff. You keep $0 of the match from all 3 years. The money was in your account, it showed up on your quarterly statement, and now it's gone. Your former employer takes it back and redistributes it to remaining employees, or keeps it to offset future matching costs. 29% of companies use cliff vesting. 41% use graded schedules longer than 4 years. The median job tenure in America is 4.1 years, which means half of all workers leave before most vesting schedules complete. This isn't an accident of bad planning. The schedules are set precisely because of that tenure data. A company that matches 4% of payroll but loses employees at year 3 on a 5-year schedule only pays out about 2.4% on average after accounting for forfeitures. The match is a retention tool that costs less than its advertised value because it's statistically designed around people leaving early. Now add the fees. Your 401k isn't just an account. It's a product sold to your employer by a financial services company, and that company charges for everything. The average 401k has 3 layers of fees. Administrative fees cover record keeping and compliance, usually 0.5 to 1% of assets annually. Investment fees are baked into the mutual funds you're allowed to choose from, averaging 0.6% for the typical plan. Then there are individual service fees, $20 to $90 if you take a loan from your own account, $75 for a distribution when you leave. A person with $50,000 in their 401k pays around $550 per year in combined fees, most of it invisible because it's deducted from returns, rather than billed as a line item. Compare that to an IRA at a place like Vanguard or Fidelity. Total annual cost for a basic IRA with index funds, around 0.1% or $50 on that same $50,000 balance. The 401k costs 11 times more because your employer picked the plan, negotiated the pricing based on their priorities, and you have no ability to shop around. You're locked into whatever provider they chose and whatever fund options that provider offers. 71% of 401k plans offer 10 or fewer investment options. The most common setup is a target date fund and a handful of actively managed mutual funds with expense ratios between 0.7 and 1.2%. You can't buy a simple S&P 500 index fund in many plans because the provider doesn't offer it or the employer didn't select it. Here's the math on what that fee difference does over time. 2 people, both contributing $500 a month for 30 years, both earning 7% annual returns before fees. Person A has a 401k charging 1% total fees. Person B has an IRA charging 0.1%. After 30 years, Person A has $508,000. Person B has $594,000. The higher fee structure cost Person A $86,000. That's not money that went to better service or higher returns. It's just extraction. The 401k provider took it, and you have no leverage to negotiate because you're not the customer. Your employer is the customer, and they optimized for ease of administration and legal liability protection, not your net returns. Then there's what happens when you actually try to use the money. Your 401k is designed to be inaccessible until you're 59 and a half years old. Take money out before that and you pay a 10% penalty plus income tax on the withdrawal. There are hardship exceptions: medical emergencies, foreclosure prevention, college tuition, but they require documentation and employer approval, and you still pay the income tax. The structure assumes you'll work continuously until traditional retirement age, which 47% of people don't. If you retire at 55, you have 4.5 years where your money is locked behind a penalty wall unless you navigate the complicated Rule 55 exception, which only works if you leave your job during or after the year you turn 55 and keep the money in that specific employer's plan. Some plans let you take a loan against your balance, typically up to 50% of your vested balance or $50,000, whichever is less. You pay yourself back with interest, usually prime rate plus 1%. Sounds reasonable until you realize you're paying that interest with after-tax dollars. You originally contributed pre-tax money, but now you're repaying the loan with money that's already been taxed, and when you eventually withdraw it in retirement, you'll pay tax again. You're double taxed on loan repayments. And if you leave your job before the loan is repaid, the outstanding balance is treated as a distribution. You owe income tax and the 10% penalty on whatever's left. 13% of 401k participants have an outstanding loan. Most of them don't know about the double taxation structure or the job loss trigger until it happens. The limited fund options mean you're often paying for active management whether you want it or not. 68% of 401k plans have target date funds as the default option. Target date funds are fine in concept. They automatically shift from stocks to bonds as you approach retirement. But the ones in most 401k plans are actively managed versions charging 0.7 to 1.0%, when passively managed versions exist at 0.1 to 0.2%. Your employer's plan picked the expensive version because the provider pushed it, or because there was a revenue-sharing agreement where some of that expense ratio goes back to offset the employer's administrative costs. You're subsidizing your employer's plan expenses through higher fund fees. Let's put the whole picture together with real numbers. You make $70,000. You contribute 6%, which is $4,200 annually. Your employer matches 50% up to 6%, so they put in $2,100. You work there for 4 years, then leave for a better opportunity. The plan has a 6-year graded vesting schedule, so at 4 years you keep 60% of the match, $1,260 per year, $5,040 total. You forfeit $840 per year, $3,360 total. That's money that was in your account and is now gone. During those 4 years, you accumulated roughly $25,000 in total balance. Your contributions plus the partial match plus growth. The fees at 1% annually cost you around $1,000 over that period compared to a 0.1% IRA. Add the $3,360 in forfeited match. You've lost $4,360 to the structure itself. If you took a loan at any point and didn't repay it before leaving, add the 10% penalty and income tax on the balance. If you were in the 22% tax bracket, a $10,000 unpaid loan costs you $3,200 in taxes and penalties. The advice you'll get is that you should still take the match because even with vesting schedules and fees, it's better than nothing. That's true if you stay long enough to vest and if you're comparing it to not saving at all. But it's not true compared to what that same contribution pattern would earn in an IRA with low-cost index funds if you had the option to choose. And for the 41% of workers who leave before full vesting, the match wasn't free money. It was a retention mechanism disguised as a benefit. Here's what to actually do. First, check your vesting schedule right now. It's in your plan documents, usually in a section called Summary Plan Description. Find out exactly how much of your match you actually own today. If you're close to a vesting cliff, that's real information for timing a job change. Second, look at your fee structure. Log into your 401k account and find the expense ratios on your funds. If everything you own is above 0.5% and there's a low-cost index option available, move your money. Third, if your employer offers a Roth 401k option, consider using it for contributions beyond the match. You lose the upfront tax deduction, but you avoid the double taxation trap on loans and you have more flexibility with Roth conversions later. Fourth, once you leave a job, roll that 401k into an IRA immediately. Don't leave it sitting in an old employer's plan where you have no control and they can change the fee structure or provider whenever they want. The 401k isn't a wealth-building gift. It's a tax-deferred account with someone else's rules, someone else's fee structure, and a matching contribution you only get to keep if you stay long enough. For some people in stable careers, that works fine. For everyone else, the math is uglier than the pitch made it sound. If you want more videos about what retirement accounts actually cost and how the alternatives compare, hit subscribe. We don't sell funds, we just read the disclosures.